You know what's wild about cryptocurrency? Everyone's telling you to go all in. Your cousin who discovered Bitcoin last month is suddenly an investment genius. Crypto finance bros are screaming about 100x returns. Every Reddit thread is pushing you to YOLO your savings into the next Dogecoin. The message is clear. If you're not betting everything on crypto, you're missing out on generational wealth. But here's the thing nobody's talking about. The actual wealthy people. The ones with millions already in the bank. The ones who understand how money really works. They're doing the exact opposite. They're capping their crypto exposure at 5% of their portfolio. 5%. Not 50%, not even 20%. Just 5%. And by the end of this video, you're going to understand why that strategy protects wealth while still capturing upside, and why copying what rich people actually do, not what broke people hope will make them rich, might be the smartest financial decision you make this year. My name is Leo, and I help people understand how wealth is actually built instead of gambling it away on whatever's trending on social media. If you want to stop making emotional investment decisions and start thinking like someone who actually has money to protect, make sure to hit that subscribe button and give this video a thumbs up if it changes how you think about crypto. Let's start with something that's going to sound harsh, but you need to hear it. The reason most people want to dump their entire portfolio into cryptocurrency has nothing to do with sound financial strategy. It has everything to do with desperation. And I get it, like I really do. You're looking at your bank account. Maybe you've got $10,000 saved, maybe $25,000. You're doing the math on how long it would take to turn that into $1 million using traditional investments. Index funds returning 8% annually? That's going to take decades. Decades of working, saving, investing, waiting. But crypto? Crypto promises to do it overnight. You see stories about people turning $1,000 into $100,000 in 6 months. Your brain does the math. If I just put my entire $25,000 into the right coin, I could have $2.5 million by next year. Financial freedom. No more job. No more struggling. This is what psychologists call lottery thinking. And it's not limited to crypto. It shows up everywhere. People buy lottery tickets. They chase penny stocks. They invest in their cousin's business idea. Because the alternative, slow and steady wealth building, feels impossible when you're starting from behind. Here's the problem with lottery thinking, though. It doesn't work. And more importantly, it's not what wealthy people do. I want you to think about someone who already has $5 million in the bank. Like, actually imagine this person. They've built wealth over 20 or 30 years. They own a paid-off house. Their retirement accounts are maxed out. They have rental properties generating passive income. They sleep well at night. Now, do you think this person wakes up one day and says, you know what? I'm going to bet everything on Shiba Inu. Of course not. That would be insane. They have too much to lose. But here's what they do instead. They allocate a small portion, usually around 5% of their total portfolio, to high-risk, high-reward investments. This includes cryptocurrency, but it could also include angel investing, venture capital, or other speculative opportunities. Why 5%? Because this is the magic number where you can capture significant upside if you're right, but you won't destroy your entire financial life if you're wrong. Let me break down exactly what the 5% rule means and why it's so powerful. Imagine you have a $100,000 portfolio. Most financial advisors will tell you to diversify across stocks, bonds, real estate, maybe some commodities. The wealthy follow this approach, but they also carve out 5%, which is $5,000 in this example, for speculative investments like crypto. Now here's where the math gets interesting. Let's say Bitcoin goes absolutely parabolic and increases 10 times over the next few years. That $5,000 becomes $50,000. Your total portfolio is now worth $145,000. You just made a 45% return on your entire portfolio by only exposing 5% to high risk. But here's the flip side. Let's say crypto completely crashes. Your $5,000 goes to zero, total loss. You're left with $95,000. Yes, that's painful. But your life isn't ruined. You didn't lose your house. You didn't have to delay retirement. You took a calculated risk, and it didn't pay off. You move on. Compare this to someone who put their entire $100,000 into crypto. If it goes to zero, they're devastated, financially and emotionally destroyed. They're starting over from scratch. They might have to work an extra decade to rebuild what they lost. The 5% rule creates what I call asymmetric risk. Your downside is capped at 5% of your portfolio, but your upside is potentially unlimited. This is how wealthy people think about speculative investments. They're not trying to hit home runs with their entire net worth. They're taking controlled risks that won't catastrophically damage their financial foundation if things go wrong. Let me give you another example with bigger numbers to really drive this home. Let's say you're in your 30s and you've managed to save $200,000 across all your accounts. Retirement funds, emergency savings, maybe some taxable investment accounts. You're doing well. You're ahead of most people your age. Following the 5% rule, you'd put $10,000 into cryptocurrency. Maybe you split it. $5,000 in Bitcoin, $3,000 in Ethereum, $2,000 in something more speculative, whatever your strategy is. Over the next 10 years, let's run two scenarios. Scenario 1. Crypto does what Bitcoin did from 2013 to 2023, roughly a 100 times return. Your $10,000 becomes $1 million. Your total portfolio is now worth $1.19 million. You've essentially reached retirement-level wealth a decade or two earlier than expected, and you did it by risking only 5% of your money. Scenario 2. Crypto goes nowhere, or worse, it crashes and your $10,000 becomes $2,000. You lost $8,000. That stings. But your other $190,000, properly invested in index funds and real estate, has probably grown to $400,000 or more over that same decade. You're still wealthy. You still retired on time. The crypto loss was a footnote in your overall wealth-building journey. This is why the 5% rule works. It lets you participate in high-risk, high-reward opportunities without gambling your entire future. Now let's talk about something most crypto influencers will never admit. The reason wealthy people cap their crypto allocation isn't because they're scared or they don't understand the technology. It's because they understand something much more important. Wealth preservation beats wealth creation once you already have money. This is one of the most critical concepts in personal finance, and almost nobody talks about it. When you don't have money, your entire focus should be on creating it, taking risks, building skills, increasing income, starting businesses. This is the wealth creation phase, and yes, during this phase, you might take bigger bets on things like cryptocurrency. But once you have money, the game changes completely. Now, your primary goal is to not lose it, because losing $500,000 hurts a lot more than never having $500,000 in the first place. Wealthy people understand this viscerally. They've spent years, sometimes decades, accumulating their wealth. They're not about to gamble it on something as volatile as crypto just because some 22-year-old on YouTube told them it's going to the moon. Think about it this way. If you have $50,000 saved and you lose 50% in a crypto crash, you're down to $25,000. That's painful, but you can recover. You're still young. You can save more. You can rebuild. But if you have $5 million and you lose 50% because you over-allocated to crypto, you're down to $2.5 million. Yes, you're still technically wealthy, but the psychological impact of losing $2.5 million is devastating. You might never recover emotionally from that kind of loss. And mathematically, you've just pushed your retirement back by years. This is why the wealthy are obsessed with downside protection. It's not about being conservative or boring. It's about understanding that once you have something valuable, your job is to protect it while still allowing it to grow. The 5% rule achieves both goals. You're protecting 95% of your wealth in stable, proven investments, but you're still giving yourself exposure to transformative opportunities through that 5% allocation. Here's another thing wealthy people understand that broke people don't. Diversification isn't about limiting your upside. It's about ensuring you get to keep playing the game. Let me tell you about Richard. This is a real person I know. Names change for privacy, obviously. Richard is in his late 40s. He built a successful business, sold it for $8 million after taxes, and suddenly he's sitting on more money than most people will earn in their entire lifetime. Richard got into crypto early, around 2017. He was smart. He allocated $400,000, exactly 5% of his $8 million net worth, into Bitcoin and Ethereum. By 2021, that $400,000 had grown to over $2 million. He was ecstatic. But here's what Richard didn't do. He didn't sell all his stocks and real estate to buy more crypto at the top. He didn't increase his allocation from 5% to 50% because crypto was obviously the future. He stuck to his plan, 5% maximum no matter how well it performed. When crypto crashed in 2022, his $2 million position dropped back down to around $600,000. He lost $1.4 million in paper gains. And you know what? He was completely fine. Because his other $7.6 million, properly diversified across index funds, bonds, and real estate, barely flinched during that same period. If Richard had gone all in on crypto at the top, he'd have turned $8 million into maybe $2 million. He'd have destroyed his financial independence in pursuit of even more wealth he didn't need. This is the paradox wealthy people understand. The more money you have, the less you need to take enormous risks to be financially comfortable. That 5% allocation is enough to capture life-changing gains if you're right, but it's small enough that you can survive being wrong. Okay, so you're sold on the 5% rule. How do you actually do this in real life? First, you need to know your total investable net worth. This is everything you have that could be invested. Your retirement accounts, taxable investment accounts, savings beyond your emergency fund, even equity in real estate if you wanted to get really precise. Let's say you add everything up and you've got $50,000 total. 5% of that is $2,500. That's your maximum crypto allocation. Now here's where most people mess this up. They think, okay, I'll put $2,500 into crypto, and then when I save more money, I'll put that into crypto too. Wrong. The allocation percentage should stay constant. If your portfolio grows to $100,000, your crypto allocation can grow to $5,000. But if crypto itself grows and now represents 10% of your portfolio, you should actually rebalance by selling some crypto and putting it into other investments. This is called maintaining your target allocation, and it's what professional investors do. Here's a simple decision tree to help you figure out your personal allocation. Are you under 30 with minimal financial responsibilities? You could probably push this to 10% if you're comfortable with higher risk. You have time to recover from losses. Are you in your 30s or 40s with significant responsibilities, mortgage, kids, etc.? Stick with 5%. This is the sweet spot. Are you in your 50s or 60s approaching retirement? Consider dropping to 2 to 3% or even eliminating crypto entirely. You don't have time to recover from a major loss at this stage. The second part of implementation is choosing what crypto to actually buy within that 5% allocation. Most wealthy people keep this extremely simple. They're not buying the latest meme coin or trying to find the next 1000x gem. They stick with Bitcoin and Ethereum, maybe 70 to 30 or 60 to 40 split. These are the most established cryptocurrencies with the longest track records. Could you make more money buying smaller coins? Sure. Could you also lose everything faster? Absolutely. Remember, the goal isn't to maximize crypto returns. The goal is to have reasonable exposure to the asset class while minimizing risk. Think about it like this. If you're only allocating 5% to crypto anyway, you don't need to take extra risk within that allocation by buying sketchy coins. The 5% allocation itself is already your risk budget. Use it wisely. Here's a framework I use and recommend to others. Within your crypto allocation, 60% Bitcoin. It's the most established, most liquid, most likely to survive long term. 30% Ethereum. It has additional utility beyond just being digital money, so it offers some diversification. 10% experimental. This is where you can scratch that itch for higher risk plays. Maybe it's Solana, maybe it's some DeFi protocol you believe in. But cap it at 10% of your crypto allocation, which is 0.5% of your total portfolio. This way, even if your experimental plays go to zero, you've lost 0.5% of your portfolio. That's nothing. You'll recover by next Tuesday. One more critical implementation point. Don't try to time the market. I know. Everyone wants to buy the bottom and sell the top. But here's the reality. You're probably not going to time it correctly. Almost nobody does consistently. Instead, set up automatic monthly purchases. If your 5% allocation equals $5,000 and you want to build up to that over time, buy $200 worth of crypto every month for 25 months. This is called dollar cost averaging, and it removes emotion from the equation. You'll buy some when prices are high and some when prices are low. Over time, you'll average out to a reasonable entry point without the stress of trying to perfectly time your purchase. Here's the thing nobody wants to hear about cryptocurrency. For most people, it's not going to be the thing that makes them rich. I know that's not exciting. I know that's not what you want to hear, but it's the truth. The real wealth builders, the people who actually accumulate serious money over their lifetime, they do it through boring, unsexy strategies. They maximize their income through career development. They save consistently, usually 15 to 20% of everything they earn. They invest in low-cost index funds that track the overall market. They avoid debt. They live below their means. These are the things that build wealth, not cryptocurrency, not stock picking, not real estate speculation. Just consistent, disciplined, long-term thinking. Crypto is the cherry on top. It's the 5% allocation that could accelerate your timeline if you get lucky. But it's not the foundation. The foundation is everything else. This is why wealthy people cap their crypto exposure. They understand that their wealth came from fundamentals, not speculation. They're not going to abandon the strategy that worked just because something shinier came along. If you're watching this video and you're thinking, but Leo, I need crypto to moon because I don't have time to build wealth slowly, I understand the feeling. But that mindset is exactly what keeps people poor. Wealth building is a game of probability. You want to maximize your chances of success over time. Betting everything on a speculative asset with massive volatility is reducing your probability of success, not increasing it. The 5% rule keeps you in the game. It gives you a chance at extraordinary returns without the risk of extraordinary losses. And more importantly, it forces you to build a real financial foundation that can support you regardless of what happens to crypto. Look, I'm not here to tell you that crypto is bad or that you shouldn't invest in it. I own crypto myself. I believe in the technology and the potential. But I also believe in protecting what you have and building wealth systematically instead of gambling it away on whatever's trending. The 5% rule isn't sexy. It's not going to make you a millionaire overnight, but it's going to protect you from the devastating losses that destroy most people who go all in on speculative investments. Rich people stay rich by not doing stupid things with their money. They take calculated risks with money they can afford to lose. They diversify. They think long-term. They prioritize wealth preservation once they have something to preserve. You should do the same thing. Start by calculating your total investable net worth. Figure out what 5% of that actually equals. Set up automatic purchases if you're building toward that allocation. And then, here's the hard part. Forget about it. Let it ride for years while you focus on the things that actually build wealth. Your career, your savings rate, your financial fundamentals. If crypto does well, great, you'll benefit. If it doesn't, you'll be fine because you were smart enough not to bet everything on one outcome. That's how wealthy people think. And if you want to become wealthy instead of just looking wealthy on social media, that's how you need to think too. Start building that foundation today. Your future self will thank you for it.